Assalamualaikum. Today our group will be present the issue about an alternative approach to distinguishing liabilities from equity. Then I will start about the introduction first. The first one is definition and characteristics of financial equity and financial liability. The definition of financial equity is the difference between the value of an individual's or entity's assets and liabilities. It is also referred to as net worth. Financial equity is more commonly called equity, and the characteristics are equity in a business enterprise stems from ownership's right. The second one is equity represents the source of distribution by an enterprise to its owner. And the last characteristic, owner equity is originally created by owner's investment in an enterprise. For financial liabilities, the definition is any future sacrifices of economic benefits that an entity must make as a result of its past transaction or any other activity in the past. The future sacrifices to be made by the entity can be in the form of any money or service owed to the other party, and the characteristics are they happen as a result of a previous transaction or occurrence. The second one is it establishes a present liability for future cash or service payment, and the last one is liabilities are an unavoidable burden. For the second one is distinguishing liabilities from equity. Based on the article, it is stated that distinguishing liabilities from equity based on ACB20603, which classifies liabilities or equity based on two features. The first one is a timing feature. The timing feature refers to an obligation to transfer economic resources at a specific point in time. And the second one is an amount features. The amount features refers to an obligation to transfer economic resources at an amount independent of the firm resources. So that's all from me. I will pass it to the next presenter.
Today I will present about the problem arise related to the issue in the article. First is about difficulty distinguishing creditor interest from owner interest. Second, distinction between liabilities and equity eliminate on the balance sheet. And third, required share repurchase classified as liability. So let's take a look one by one. One problem that has plagued the profession in distinguishing liability from equity is the inherent difficulty of distinguishing creditor interest from owner interest. Although each of firms claim and bear some portion of its business risk and have rights to cash flow from future income and liquidations, it is not clear what level of risk a claimant must bear or what rights to cash flow it must possess to be considered an owner rather than a creditor. In 1990, the FSB issued a discussion memorandum questioning whether the distinction between liabilities and equity should be eliminated on the balance sheets. Clark 1993 provided a detailed review of the accounting and finance literature on capital structure and conclude that the distinction is economically informative. In 1993, the American Accounting Association Financial Accounting Standard Committee notes that it is useful that it ascribes meaning to income and maintain relative consistency between financial and tax accounting rules. In October 2000, the FASB issued two exposure drafts on distinguishing liability from equity. The first one is to address the liability-equity classification of claims with characteristics of both liability and equity and propose that claims that impose an obligation to transfer assets or stocks to be classified as liability. The second is to propose an amendment to the concept number 6, definition of liability, to include present obligation that require the issuer to transfer a fixed dollar amount of share of its own stock. In 2003, the FSB incorporated some ideas from exposure draft by issuing Statement of Financial Accounting Standard Number 150, which require that share repurchase obligation to be classified as liability. For example, mandatorily reimbursed preferred stock. The standard deferred liability on other types of claims with the characteristic of both liability and equity, including putable shares, convertible bonds, and dual-index financial instruments. After the issuance of ASF 150, FSB attempted to address the liability-equity classification issue on a more fundamental level. In 2007, they published a review document that outlined three possible approaches to distinguishing liability from equity. First, basic ownership approach. Second, the ownership settlement approach. And the third is the arrest expected outcome approach. The basic ownership approach restricts equity classification exclusively to common stock, where the other approaches are less restrictive and include some hybrid security in the equity category, for example, preferred stock. If ESB favored the basic ownership approach, noting that it provides more decision useful information to investors while significantly simplifying accounting requirements for issuer and auditor. However, the preliminary review on the basic ownership approach did not result in changes to the financial reporting standard for classifying financial instruments.
Now, I will explain about how the approach might be used to settle the issue. First is specificity of settlement, and second is timing and form of settlement. Claims with contractually specified settlement include claims in which the claimant and issuer are contractually obligated to settle the claim in the future, for example, long-term debt, and claims in which either the claimant or the issuer has the right but not the obligation to settle the claim in the future, for example, employee stock options and redeemable preferred stock. And second is claim with specified settlement could be further sorted into secondary subspecifications for timing of settlement, current and non-current, and form of settlement for asset settled and claim settled. For example, long-term debts claim could be presented within the specified settlement subspecification as non-current asset settled liabilities. In contrast, currently accessible employee stock option could be presented within the specified settlement subspecification as current claim settled liabilities.
Next is our last part, which is conclusion on comment on issue highlight. First is emphasizing the concept of ownership in financial reporting represent a radical departure from the current model. In our view, this departure is warranted if the accounting profession wishes to arrive at a satisfactory conclusion to the issue of distinguishing liability from equity. Next is the problem of heterogeneity exists regardless of how liabilities and equity are distinguished from another on the balance sheet. In our view, the problem of distinguishing liabilities from equity distinct from the problem of heterogeneity, and that the former should be addressed before the latter. Our suggested system of subclassification results in a maximum of 5 subclassifications within the liability section. We contrast our method for recognizing the cost of shareholder capital with the effective interest method for recognizing the cost of debt capital under current financial reporting standards. Specifically, under the effective interest method, the cost of debt capital is recognized as an expenses during the period of time in which the capital is used, and not necessarily when the cost is paid in the form of periodic coupon payments or and maturity. That's all from our group. Thank you.